In this video, we're going to talk about understanding interest rates and the Federal Reserve. What are the functions of the Federal Reserve and how the Fed influences interest rates? The Federal Reserve, often referred to as a bank's bank, is an independent government body that controls the country's monetary policy. In other words, it influences the amount of dollars available at private banks and can alter the velocity of money or how quickly money is exchanged. The end goal is to maximize employment while also keeping inflation under control. The Fed has a number of tools at their disposal to accomplish these goals, and one of the major ones is its ability to influence interest rates, which it does by setting the interest rate that other banks must pay to borrow money from the Fed. The tool not only gives the Fed the power to manipulate the broader interest rate charges by lenders and paid by borrowers, but it gives banks a way to fill short-term gaps in liquidity, giving the U.S. financial system another source of stability. So the Fed, or the Federal Reserve, manages inflation, supervises the banking system, maintains the stability of the financial system, and provides banking services. So when should the Fed influence interest rates? Usually, interest rates are pushed down when the economy is in a recession because lower interest rates allow money to be exchanged more freely and therefore can help kickstart an anemic economy. In economists' circles, this is part of what is called expansionary monetary policy. An example of this scenario played out during the 2008 financial crisis. Following the crash, interest rates dropped to as low as 0.25%. Interest rates are raised when inflation or increases in the price of goods and services becomes too high. While a quick growing economy may seem like a good thing in any circumstance, if full employment is reached and too much economic momentum is converted into wage increases too quickly, it can have a negative impact on overall price levels. In the worst-case scenario, the price of goods and services could rise significantly faster than income, which not only reduces the purchasing power of a dollar, but also lowers the value of savings. Monetary policy is a balancing act, and if carried out responsibly, can help flatten the usual roller coaster ride of the boom and bust economic cycle.